So the VT Gravis UK Infrastructure Income Fund was launched in January 2016 and seeks to provide exposure to the UK infrastructure sector by investing a portfolio of listed companies which own and operate physical infrastructure projects that benefit from high levels of contracted revenue streams. So these companies, which may be structured as closed-ended companies, REITs or traditional equities, own or have a mandate to manage critical assets such as schools, hospitals, GP surgeries, logistics assets such as warehouses or transport networks, energy generation, transmission or distribution assets, water supply, waste treatment plants, and digital infrastructure assets such as data centres or broadcast towers. So from a top-down perspective, the fund is clearly quite thematic in nature, but does not have constraints with regards to its allocations towards underlying infrastructure subsectors. When constructing the portfolio, I would highlight a number of key guidelines. One, we look to maintain an overarching exposure to operational assets, and that's opposed to development stage or even construction stage projects. Number two, we want to maintain a high level of exposure towards revenues that benefit from government support or are derived within a regulatory framework. Number three, we want limited exposure to infrastructure projects that rely on volume of use or cyclical demand drivers. We are long-term investors and expect to hold positions in the portfolio for a long time. So whilst the fund is actively managed, it is not aggressive in terms of stock turnover. The fund has a clear income target of 5% net of fees, and so this is also a key consideration as part of the portfolio construction process. So on the face of it, the portfolio is high conviction and concentrated with about 30 holdings, a typical kind of level. However, investors should take comfort in the large number of underlying projects and assets to which the underlying companies are exposed. At present, we estimate more than 1,500. So the portfolio is more diverse than one might think, and risk is spread across a wide range of different projects as well as infrastructure subsectors. So listed infrastructure companies often benefit from long-dated contractual revenues and will value their assets using a discounted cash flow model. The primary return element is often via income distributions, and as such, they are often referred to as bond proxies. So there is duration risk, and that is to say that movements in reference government bond yields can impact the present value of infrastructure assets. This is partially mitigated by indexation or inflation linkage in the underlying revenue streams. So the fund has no formal ESG constraints in the mandate. With regards to governance best practice, the fund votes systematically in accordance with ISS sustainability recommendations. So within a multi-asset context, we think the fund provides exposure to a unique area within capital markets. Investors will often use it as an alternative income exposure, as an alternative to traditional fixed income exposures or even physical property. The revenues generated by the underlying companies in the portfolio are in the main uncorrelated with cyclical trends, and so the broader infrastructure sector is often viewed as having the potential to offer a safe harbour in economic downturns, for example.